Good afternoon. This is my Strategies for Fiscal Management case study on Lululemon. Lululemon is based in Vancouver, British Columbia. It is a high-end, customer-centric athletic and fitness clothing digital fitness retailer. It all began in 1998 as a design studio by day and yoga studio by night. In 2000, the first standalone store was established, and by 2007, the company had gone public. By 2021, Lululemon was reporting a $2.4 billion gross profit. Review of the last 3 years of financial data shows a financially sound company showing solid numbers across the board in indicators from the profit and loss statement and also the balance sheet, as you can see here. While revenue and gross profit grew over this time frame, operating and net profit slightly dipped in 2021. Total assets and total owner's equity, as well as COGS and inventory, all grew over the 3 years. Now, let's take a look at some of their financial ratios. Gross margin remained steady. However, while still acceptable, operating margin and net margin both saw fluctuations. Return on assets and return on equity both saw very sharp declines over the last 3 years. The declining return on equity indicates that the company may have made some poor decisions with capital investments. This could also be related to the declining return on assets, which indicates the company's assets are probably underperforming. The efficiency ratios are on par with the industry, as we will see in our market comparison shortly. The liquidity ratios are both greater than 1, which is positive, meaning Lululemon is capable of paying creditors over the next 12 months with cash and assets if needed. Their debt to equity ratio is less than 1, which means that Lululemon's debt is less than their equity, which segues into the fact that the interest coverage is 0. The earlier slide showed Lululemon did not report any interest payments on their financials. Analyzation of these ratios gives me some pause. While their ratios are within acceptable limits, and in some cases they are outperforming their competition, as we will see, there is some concern about the sharp declines on operating and net margins, as well as return on assets and return on equity. These declines could indicate trouble on the horizon. Here we can take a look at the market comparison I have put together. As I previously mentioned, if we look at how Lululemon has fared versus Nike and Under Armour, Lululemon has been outpacing both of these competitors in 2019. We move to 2020, and again, Lululemon outpaces both companies. It's important to mention at this time, Under Armour has reported negative margins relating to their profitability ratios. Forward to 2021, and again, Lululemon is outpacing the competition, but Under Armour is starting to show some improvements, and Nike's ratios are also on the rise. However, here we see those concerning numbers on return on assets and return on equity, where Nike far outpaced Lulu. This slide indicates that Under Armour, though struggling, is becoming profitable again, but Lulu and Nike are the big winners in this market. We have reviewed the financials, the ratios, and did a market comparison, and have established that Lululemon is a solid company with some indications that they may not be managing their assets to their fullest potential, or they may have made some capital investments that did not perform as expected. Let's look at the percentage change. Here we see that the percentage change across these key indicators show sharp, if not drastic, drops. Lulu is profitable, but they experienced a slowdown in revenue growth of the 3-year period. The operating profit and the net profit percentage change is quite concerning. These drops are more significant and show a negative growth rate between 2020 and 2021. This may be related to Lulu's 2020 $500 million purchase of the Mirror, the digital fitness system. At the time of purchase, we were in a global pandemic, and fitness consumers were looking for innovative equipment to enable them to continue their fitness lifestyle. Further research showed that the projected sales were between $250 million to $275 million from the Mirror, with its corresponding subscriptions. However, these sales fell drastically short, with the company reporting roughly $130 million in sales. This less than spectacular sales is due to the end of lockdowns and consumer returns to in-person gyms and pre-COVID fitness activities. So my recommendation: even though the company appears solvent with the ability to pay creditors with cash and assets if necessary, the revenue, operating, and net profits, while still positive, are on the decline. The margins too are positive, however, they too are also declining. The game changer for me is the return on assets and return on equity. Taken with the drastic percentage change data we reviewed, shows the company has not managed its assets or its equity in such a way that would strengthen its financial position. It also appears to have gambled on a digital fitness product, much like Peloton, that fizzled out with the end of lockdowns, with no clear indication of contingency strategy to address this. Based on the information I have presented here, I would recommend holding on the investment in Lululemon. Thank you for your time.